In 1950, the average American household had zero credit card debt. Not because they were disciplined, not because they were wise with money, because credit cards didn't exist yet. Then, in 1958, Bank of America mailed 60,000 unsolicited credit cards to the residents of Fresno, California. No application, no approval process. Just a card in the mailbox. Within a year, over 20% of those cards were in serious default. Bank of America called the experiment a disaster. Then they noticed something else. The other 80% were spending more than they ever had before, and they were paying interest. Within a decade, the Bank Americard had been licensed to banks across the country. You know it today as Visa. That single mailing in Fresno, California didn't just launch a product. It launched a new relationship between Americans and debt. One that has quietly reshaped how an entire civilization thinks about money, time, and freedom. And most people living inside that relationship have never stopped to ask a simple question. Who benefits when you borrow? Because it's probably not you. For most of human history, debt was a last resort. You borrowed when you had no other option, when the harvest failed, when illness struck, when survival required it. Debt carried social stigma. It signaled failure, not sophistication. Then something fundamental shifted. Debt was rebranded, not as a sign of need, but as a sign of access. Not as a burden, but as a tool. Not as a trap, but as freedom. Today, the average American household carries $104,215 in total debt. That includes mortgages, auto loans, student loans, credit cards, and personal lines of credit. That number is not a crisis statistic. It is considered normal. Because over 70 years, the financial industry performed one of the most successful rebranding operations in economic history. They didn't sell debt. They sold the life debt could buy. Picture the machine they built to do it. A credit card statement arrives each month. It shows the minimum payment, large and clear. It shows the balance, smaller, lower down. It does not show the payoff date. It does not show the total interest you will pay. Those numbers are calculated internally. They are not shown to you. And then they collected interest on the gap between the life people wanted and the life they could actually afford. To understand the debt trap, you need to understand one simple idea. When you borrow money, you are renting purchasing power from the future. The interest rate is the rent, and the rent compounds. At 20% APR, which is close to the current US average, you pay almost double the original amount before you're free. But here is the part that doesn't appear on the statement. While you're paying interest on money you already spent, someone else is earning interest on money they own. Same dollar amount, two completely different trajectories. One path, you pay the bank. The other path, the market pays you. Over 20 years, the gap between those two paths exceeds $80,000 from a single decision. This is not just math. This is a transfer from millions of individuals to a small number of institutions. Every dollar of consumer interest moves quietly and permanently from the borrower's future to the lender's present. In 1998, behavioral economists Dražen Prelec and Duncan Simister published a landmark study at MIT. They found that people consistently spend more when paying with credit than with cash, sometimes up to 100% more for the same item. The study demonstrated that the physical act of paying cash activates what they called the pain of paying, a genuine neurological response that naturally limits spending. Credit cards eliminate that pain entirely. The purchase and the payment are separated in time. The brain treats them as disconnected events. This separation is not an accidental feature of the credit system. It is the core product. The industry understood, decades before neuroscience confirmed it, that decoupling the pleasure of buying from the pain of paying would unlock levels of spending that cash-based economies could never reach. And they were right. US consumer credit card spending in 2023 exceeded $5.8 trillion. That number does not represent prosperity. It represents a system that turned a biological weakness in human cognition into a $200 billion annual revenue stream for the banking industry. Here is what they never put in the brochure. The minimum payment on your credit card is not designed to help you pay off your debt. It is designed to keep you in debt for as long as mathematically possible. A $10,000 balance at 20% APR paid at the standard minimum payment of 2% takes 44 years to clear. Total cost $31,722. You borrowed $10,000. You paid back $31,722. The extra $21,722 did not build anything. It did not invest in your future. It did not create equity. It did not compound. It transferred directly from your account to the bank's income statement. The minimum payment is not a lifeline. It is the mechanism that keeps you paying for decades. There are two kinds of debt in the modern economy: debt that builds assets and debt that builds someone else's assets. The difference between them is not the interest rate. It is not the lender. It is what happens on the other side of the transaction. One kind of debt purchases something that compounds. The other purchases something that depreciates, or worse, something already consumed. Mortgage debt on an appreciating property can build wealth over decades. Credit card debt on a vacation taken 3 years ago is still compounding today. And most people carrying consumer debt have never been taught to see that distinction. The most dangerous feature of the debt trap is not financial. It is psychological. A 2021 study by researchers at Columbia Business School found that individuals who carry significant consumer debt consistently underestimate their total outstanding balances by an average of 37%. They don't know how much they owe, not because they are irresponsible, because the brain, when facing financial stress it cannot solve, activates avoidance, the same mechanism it uses to protect itself from physical danger. You stop looking at the number, because looking at the number produces anxiety that feels indistinguishable from real threat. And avoidance of the number makes the number grow. This is the debt identity, a state in which debt becomes a background condition of life rather than a solvable problem. Invisible, normalized, and quietly compounding while the person above it focuses on everything except it. The industry benefits from this psychology. The longer you avoid the number, the longer the interest accumulates. Meet Marcus. He's 32, works in logistics, makes $58,000 a year. He doesn't think of himself as someone in debt trouble, He has $9,400 across 3 credit cards. He pays the minimums every month, always on time. His credit score is good. He's responsible. He checks his app once a week. He sees the minimum, he pays it, and he moves on. What Marcus doesn't know, what the statement never shows him, is a number called his payoff date. If Marcus continues paying minimum amounts on those 3 cards at current rates, he will finish paying them off in the year 2043. He is 32 today. He will be 51 before those purchases are cleared. The vacation from 2022, the laptop from last year, the medical bill he put on the card because it was easier. Still generating interest, still compounding, still redirecting money from his future into a bank's quarterly earnings report. The same $9,400 invested instead of borrowed would have moved in the opposite direction. Marcus is not reckless. Marcus is not uninformed. Marcus is inside a system that was engineered to extract value from people who pay on time and never miss a payment. The perfect customer. Because perfect customers carry balances forever. Not all debt is the same. Debt is not inherently bad, but most people are never taught how to use it correctly. There is a version of debt the system profits from, and a version of debt the system respects. The difference is not the lender. It is not the interest rate. It is what happens on the other side of the transaction. When debt purchases something that appreciates, a property, a business, a skill that commands higher income, the borrowed capital is working in your direction. The interest is the cost of accelerating your position. When debt purchases something that depreciates, or worse, something already consumed, the borrowed capital is working against you. You are paying rent on a memory. The mortgage that lets you own a home in a market that grows for 30 years is not the same instrument as the credit card balance from a dinner you ate 3 years ago. Both are called debt. Only one compounds in your favor. The question to stop asking is, can I afford the monthly payment? That is the question the industry refined over decades because it keeps your focus on cash flow and away from total cost. The question to start asking is simpler. When this debt is gone, will I own something? Or will I have nothing except a longer credit history? Getting out of the debt trap requires understanding which type of debt you're carrying and treating each type differently. For high-interest consumer debt. The Avalanche method. List every debt by interest rate, highest first. Minimum payments on everything. Maximum payment on the highest rate debt. When it clears, redirect everything to the next. This minimizes total interest paid. It is mathematically optimal. The psychology of it is harder than the math, because the highest rate debt is rarely the smallest. Progress feels slow. But slow progress at the right target beats fast progress at the wrong one. For mortgage and asset debt. Hold. Let the asset appreciate. Let inflation erode the real value of the debt. Refinance when rates fall. For student debt. Calculate the actual return on the credential. If the credential produces income above the monthly cost of the debt, structured repayment over time is rational. If it does not, aggressive repayment first. The framework is always the same. Does this debt produce more than it costs? If yes, structure it. If no, eliminate it as quickly as possible. There is a line that rarely appears in financial education. The credit card industry earns more money when you are financially stressed than when you are financially stable. When you are stressed, you carry balances. When you carry balances, you pay interest. When you pay interest, they profit. This is not conspiracy. It is the natural incentive structure of an industry whose revenue model depends on the gap between what people earn and what people spend. The system doesn't need you to fail. It needs you to stay. The system is not broken. It is working exactly as intended for the people who built it. Understanding this does not make you cynical. It makes you precise. Because the moment you see the system clearly, the moment you understand that minimum payments are a product, not a lifeline, that decoupled payment is a feature, not a convenience, that the average American will pay over $200,000 in interest across a lifetime, you stop negotiating with the system on its terms. And you start setting your own. In 1958, when Bank of America mailed those 60,000 cards to the residents of Fresno, most of the recipients had never had credit before. Many of them spent freely, assuming the card was a form of money they had earned. They hadn't. They had borrowed against their future selves. And the system that gave them those cards understood something they didn't yet. Marcus understands it now. He looked up his payoff date. He saw 2043. Then he did something the statement was never designed to make easy. He calculated the total. And he stopped negotiating with the system on its terms. The debt trap is not about spending too much. It is about borrowing without understanding who benefits when you do. You can use debt as a tool, or debt will use you as a tool. The difference is not income. It is not discipline. It is the moment you stop asking, "Can I afford this?" and start asking, "Who gets rich when I sign here?" We have talked about intelligence that doesn't create wealth, income that doesn't build wealth, ownership that most people never reach, starting that most people never do, and now, debt that quietly drains what's left. Debt doesn't just take your money, it takes your time. But there is a system even more insidious than debt, one that doesn't take your money directly. It takes something harder to recover. Your time. Your attention. Your ability to think clearly about the future. That's the attention trap. And that's next.